In the world of finance, few avenues offer the same potential for wealth creation as the stock market. While it may seem daunting at first, the stock market is accessible to anyone willing to learn the basics and embrace a long-term perspective. Investing in stocks is not about getting rich quickly. It's about participating in the growth of companies and, in turn, growing your own wealth gradually over time. This essay will equip you with the foundational knowledge and practical steps to embark on your stock market journey. Imagine owning a small piece of a thriving business, benefiting from its successes and growth. That's precisely what it means to own stock. When you buy a stock, you're purchasing a share of ownership in a company. As the company prospers, its value increases, and so does the value of your stock. The stock market is simply a marketplace where these shares are bought and sold, connecting buyers and sellers from around the globe. However, it's crucial to approach the stock market with a balanced perspective. It's not a guaranteed get-rich-quick scheme. Prices can fluctuate, and there will be periods of both gains and losses. That's why it's essential to adopt a long-term investment horizon, focusing on the overall growth potential of the companies you invest in. By understanding the fundamental principles of investing and developing a sound strategy, you can navigate the stock market with confidence and position yourself for financial success. Before diving headfirst into the stock market, it's crucial to grasp the different types of stocks available to investors. Primarily, we have common stocks and preferred stocks. Common stocks represent ownership in a company and typically come with voting rights, allowing shareholders to participate in company decisions. Preferred stocks, on the other hand, often do not carry voting rights but offer a fixed dividend payment, providing investors with a steady stream of income. Understanding these distinctions is key to aligning your investment choices with your financial goals. If you seek potential for capital appreciation and want a say in company matters, common stocks might be suitable. If you prioritize regular income and prefer a less volatile investment, preferred stocks could be a better fit. Beyond the types of stocks, it's essential to familiarize yourself with key financial metrics used to evaluate companies. Earnings per share, EPS, indicate a company's profitability, while the price-to-earnings, PE ratio, helps assess its valuation relative to its earnings. Dividend yield reflects the annual dividend payment as a percentage of the stock price, providing insights into income potential. By understanding these metrics, you can start to analyze companies and make more informed investment decisions. When it comes to evaluating potential investments, investors typically employ two primary approaches: fundamental analysis and technical analysis. Fundamental analysis delves into a company's financial health, examining its revenue, earnings, debt levels, and management quality. This approach aims to determine the intrinsic value of a stock, assessing whether it's undervalued or overvalued by the market. Technical analysis, conversely, focuses on historical price movements and trading volume to identify patterns and trends. Traders employing technical analysis believe that past market behavior can offer insights into future price movements. They utilize charts, indicators, and other tools to spot potential buying or selling opportunities. Both fundamental and technical analysis have their proponents and critics. Fundamental analysis provides a solid foundation for understanding a company's financial health and growth prospects. Technical analysis, while often used for short-term trading, can complement fundamental analysis by identifying entry and exit points. Ultimately, the best approach for you depends on your investment style, risk tolerance, and time horizon. In the world of investing, diversification is often referred to as the only free lunch. It's a strategy designed to mitigate risk by spreading your investments across a variety of asset classes, industries, and geographical regions. The underlying principle is simple: don't put all your eggs in one basket. By diversifying your portfolio, you reduce the impact of any single investment on your overall returns. If one stock or sector performs poorly, others can potentially offset those losses. This approach promotes long-term stability and resilience in your portfolio. There are various ways to achieve diversification. You can invest in a mix of stocks, bonds, real estate, and commodities. Within each asset class, you can further diversify by investing in different sectors, company sizes, and geographical locations. Mutual funds and exchange-traded funds, ETFs, offer a convenient way to achieve instant diversification by investing in a basket of securities with a single transaction. Embarking on your stock market journey might seem daunting, but it's more achievable than you might think. Start by setting clear financial goals. Are you investing for retirement, a down payment on a house, or your children's education? Defining your objectives will help determine your investment horizon and risk tolerance. Next, choose a reputable online brokerage account that aligns with your needs. Consider factors such as trading fees, research tools, and account minimums. Once your account is set up, it's time to fund it. Start with an amount you're comfortable investing, knowing that you can always add more later. Now comes the exciting part, selecting your investments. Begin by researching companies that intrigue you or align with your values. Explore their financial statements, understand their business models, and assess their growth potential. Don't hesitate to seek advice from financial advisors or experienced investors. Remember, investing is a continuous learning process. Investing in the stock market, while potentially lucrative, is not a guaranteed path to riches. It requires patience, discipline, and a commitment to continuous learning. The stock market is a dynamic environment influenced by a myriad of factors, from economic indicators to geopolitical events. By embracing a long-term perspective, diversifying your investments, and staying informed about market trends, you can navigate the stock market with greater confidence and position yourself for financial success. Remember, investing is not about timing the market, it's about time in the market. As you embark on your investment journey, approach it with a measured and informed mindset. Don't be swayed by short-term market fluctuations or get-rich-quick schemes. Instead, focus on building a diversified portfolio of quality investments, reinvesting your earnings, and letting the power of compounding work its magic over time. The stock market, when approached wisely, can be a powerful engine for wealth creation and financial security.